Good afternoon, everyone. It is a beautiful day, and I'm feeling very smug not being in 2 degrees and rain in London. Unless you've been living under a rock, DATs have been taking over this year. Over 4% of Bitcoin is now in a DAT, 1% of Solana, and over $130 billion total net worth for DATs. This is obviously going to cause eyebrows to raise in governments, and compliance is such a big topic. So today we're talking about compliance or collapse, the new rules of digital asset investing. So I'm very lucky to be joined by 2 wonderful panelists. Please give a quick introduction.
Hello, my name is Gino. I'm the Chief Compliance Officer of Laser Digital. I'm a regulatory lawyer, and I'm actually super excited about how we utilize regulatory frameworks to enable new business models, especially in the digital asset space. Before I joined the more exciting crypto world, I was working in TradFi in various roles in legal compliance and risk management.
Hi everyone, my name is Robert. I'm working for ADI Foundation, which is based here in Abu Dhabi. I'm a DeFi, decentralized finance asset manager. We are launching a blockchain here, which is compliant native. Before that, I was based in Switzerland, worked for a bank, but I have more a crypto type of background.
Amazing. Well, the title says it all, compliance or collapse. Are we really at a point where a failure to comply could end an entire project, or is that just the new narrative?
So obviously this title, comply or collapse, is a bold statement, but if we zoom out and look into the regulatory developments in the crypto space, and when we go back to the earlier years where basically the regulatory framework was regulating traditional financial intermediaries, because if you didn't have a license, you were simply not able to provide any type of financial services, and that has changed with technological development. Suddenly distributed ledger technology was out there and available to actually provide products and services where historically you would have needed a bank or an asset manager. But suddenly a smart developer was able to create outstanding products which actually are financial services, right? And regulators didn't see that coming as such. And these tech guys, at least in the very early days, they didn't care about regulations. So if we see all the big crypto exchanges, they typically started as unregulated tech companies and grew massively in terms of users as well as trading volumes. And then suddenly regulators did realize, okay, these are actually financial services which are also utilized by illicit actors. Because typically if you don't have a license and you're unregulated, you don't have compliance measures in place. And that obviously is a vulnerability in the system. So people who want to launder money or want to move funds without being tracked by the government started to utilize this technology. And this is where also then regulators stepped in and issued licensing frameworks. And suddenly what was perceived as a technology service only, which is typically unregulated, suddenly trigger license requirements. And this is why I would say it's a fair statement that nowadays, in most of the jurisdictions, if you provide financial services by means of DLT, you need a license, and therefore, if you don't have a license, you're non-compliant, and if you're non-compliant, you get fined, and this is not what you want, or at least you don't want to face these consequences. And this is why my conclusion is nowadays, you need to be compliant. Most of the jurisdictions have introduced licensing requirements by now, if your business model is considered as financial services. So therefore, it's not a choice which you can make, it's an imperative to be compliant.
Yeah, I really agree with that point, and I think early days in exchanges, especially my exchange, we were going around in circles, actually waiting for this regulation to come. So that actually really slowed down the innovation. Do you have a point to add?
Yeah, no, I agree with you. It also depends on what you are trying to achieve and what to build, right? Are we speaking about building an exchange, a decentralized exchange, compliant blockchain like ADI is doing, or maybe Polymarket? And I think it was one of the latest great example that if you don't comply from the very beginning, you may have like troubles, like you are scaling your business, everything going well, then regulators come and oops, you are, like banned in certain countries, and therefore you are like using your user base. So being compliant from the very beginning is a today clear choice, especially if you want to reach institutional grade and go for businesses and the sovereign initiative. You don't have much choice.
In the keynote from Herman earlier, he was talking about how it's actually really bad that digital assets are not getting direct revenue from the things, because wasn't that by design, so they weren't securities? You know, when we look at moving away, we didn't want direct revenue from the tokens, from the projects to the tokens, so that they weren't securities. Is that changing now?
I mean, the topic whether a token is a security or not has far-reaching implications, because if a token is deemed as a security, then typically securities regulations are kicking in, and these regulations were designed for rather large-scale companies who want to be listed and need to comply with so many rules, right? But at the same time, it also is quite a high burden to meet these requirements of being listed on a traditional stock exchange. And that leaves out a lot of smaller innovative companies who want to raise money but don't have access to traditional exchanges like TradFi exchanges, right? And this is where technology obviously offers great opportunities for smaller projects, and smaller projects, as we have seen with some token raises, still can be hundreds of millions or even billions. But it provides a new gateway to access capital. Now, accessing capital typically requires investor to invest, right? And this is where then the idea of the regulation is actually designed to protect investors on one side, but on the other side also protect integrity of financial markets, right? And if you behave like you are in the TradFi space, then obviously also regulators will apply the same rules. And nowadays in most of the jurisdictions there is a lot of clarity how to launch a token. Is it a security or not? What are the consequences? And in the early stages, that was not clear. And even if companies wanted to comply, there was a lack of regulatory frameworks applicable, because a lot of jurisdiction in the early days, they didn't have specific rules how to regulate these type of new asset classes. And there were regulators who applied a more technology-neutral approach, where basically said if it looks like a share or an equity, we treat it as such, regardless whether you issue a piece of paper or digital certificate or a token on the blockchain. And while in others it was unclear, and it was also hard for these issuers to be compliant, while nowadays that regulatory clarity has massively improved in a lot of jurisdictions. It's quite easy now to be compliant. There are obviously also differences in different jurisdictions. So the question is, what is the best suitable framework for the specific offering? But at the end of the day, in jurisdictions where you have clarity, you know what would trigger a security qualification of your token, and you can design then the tokenomics and other features around that.
Yeah, I can add something about the topic. As yesterday, we got our TG, token generation event. So
Congrats. Always exciting.
Yeah. I was into it. I was into tokenomics. Actually, I will share you two experiences. Today, when you launch a token, you don't have much choice. You have to comply with the regulatory environment, whether you are a security or utility token. You don't have much choice. Otherwise, you have no chance actually to hit the market. Here in Abu Dhabi, you have a clear framework with ADGM that you have to actually show that either you are a security or utility, and then you get from a law firm company what they call a legal opinion letter. So that's a must. You don't have the choice. So that went quite smooth on our side. Back in the days, like I think it was 5-10 years ago, I was also advising a project in Switzerland. And the guy didn't do the effort of understanding what's a security, what a utility. They say, okay, I will not say the word, but let's go for it. They went on an exchange. They paid the fees of the exchange. And then the guys said, guys, you are not a utility, you are a security. Yeah. Thanks for the money, we are not going to list you. Yeah. And that's the reality. But it has evolved. I mean, I've seen that. So a few years back, it was possible to be in a vague environment. Today, it's impossible. You have to be very compliant. and very, towards the investors, you have to be very clear, and that's a good path after years that we all took.
Yeah, amazing. For the work I do with Stand With Crypto, we are lobbying the UK government, but when I look at what Abu Dhabi is doing, I'm like, wow, I wish our government was moving as fast as they are. And how has compliance evolved from being just a checkbox to like more of a differentiator? I'm going to invest in this token because it is compliant, or is it just a checkbox so you don't get in trouble?
It's definitely more than just in not getting into trouble, but it's also business enabling, as we just have heard on the example, right? So if you're an exchange and you're not able to cover security tokens because your license type does not allow you to offer trading of securities, then having a compliant framework, in the specific case a license to trade security, is a business enabler for the exchange as such, but is also a business enabler then for these companies who are issuing tokens, which then by design are actually securities. And a couple of years ago, the licenses available to trade securities were basically limited to a stock exchange, a TradFi stock exchange, right? But building a TradFi stock exchange is very heavy lifting, right? And TradFi stock exchanges didn't want to list digital securities, i.e. security tokens, right? So there was a gap which actually the regulatory framework was not able to bridge, but with recent developments like in the ADGM, as you mentioned, right? So there were new license types available, which actually providers were able to offer then in exchange for security tokens as well, but with much lower requirements because the risks were different. There was not necessarily separation required of who provides the custody or the CSD for the securities booking. So regulators have seen that with DLT, a lot of risks actually could be reduced, and that means also that the license regime should adapt, and regulators have implemented that quite successful, which gives them the opportunity to the market to cover these types of products in a compliant way, therefore giving investors access to it in a safe way on one side, but also enable token issuer to access additional liquidity, whereas beforehand on a traditional stock exchange, they would never have been listed.
Yeah.
I agree with you. I mean, you said pretty much everything. It's more than a checkbox. It has to be also coming from the infrastructure architecture you are building. Speaking about our case as a blockchain, it has to be compliance from the very beginning, especially depending if you are targeting institutions, governments. That's definitely a must, and there's no way you can scale the business without.
Maybe also to add on that topic, right? So if you launch a new project and you don't care about regulations, then obviously you will get a problem with regulators depending on the jurisdiction where you are. But let's zoom out and not only cover the compliance and regulatory angle, but also the business angle, right? So if you launch a super innovative project which is clearly providing financial services where you are supposed to have a license for it, even if you are unregulated, you might still be able to attract sophisticated crypto-native users who don't care much whether your offering is regulated or not, because they do their own homework, they understand the risks, and they understand the technology which you are using. In best case, they even can do their own audit of the smart contracts which you are using. And that's basically one customer group, and this group you can serve or address. But there is a bigger group which is basically large-scale retail market of people who are not necessarily educated about the risks, and they're obviously missing out on these opportunities. And in order to bridge that gap, there are actually the institutional players who can bridge this gap and basically provide retail investors or even high net worth individuals or professional investors who don't have necessarily the technical know-how to understand investments and on such innovative platforms like decentralized exchanges or borrowing lending pools. But the problem then for these institutional players who are utilizing money which belongs to others, they have fiduciary duties, right? And they need to do due diligence about the platforms. They would route their own customers. They would need to do due diligence regarding the offering where they put money of their own clients in. And these institutional players will stay away from unregulated offerings, because the risk at the end of the day is way too high. And this is where regulation and compliance enables this additional liquidity from institutional players, because institutional players cannot access unregulated offerings, and for sure not those which are in clear breach of licensing requirements.
Yeah, and that's definitely what we've seen this year. This is really the year the institutions have come in a really big way. I made a bad joke on Twitter. Hungary became hangry as they banned Revolut from selling crypto, and they're going to war there. I guess regulators' roles whenever we have a new technology is a mixture of trying to allow innovation but protect consumers. And are regulators catching up fast enough to allow this pace of innovation to happen, or are the companies still kind of forced to operate in uncertainty, waiting for this regulation? And it could be different jurisdictions.
I would say it's a fair statement that at the end of the day, regulators cannot ignore technological advancements. That's just a matter of fact. And in not regulating new ways to provide financial services, this is a blocker for innovation. And the risk there is that these developments will happen then anyway, but also exposing consumers and investors to the increased risk of consuming unregulated products and services. So at the end of the day, it's win-win for both regulators as well as consumers to have clear frameworks in place. And here obviously we see different approaches of different regulators. You mentioned before the example with the UK as well as the example here in Abu Dhabi in the ADGM. And obviously regulators who are able to issue clear frameworks and adapting to developments from a technology point of view, but also from a customer/investor point of view. And those are able to attract the innovative players who want to be compliant. And in the race of providing best ecosystem, obviously jurisdictions with adaptive regulatory frameworks will win the race.
Yeah, and we were discussing that just before. Actually, regulators attract business. They bring clarity to businesses as well. If you compare worldwide, I mean here in Abu Dhabi, ADGM, it's very, very proactive, which is very good for businesses if you compare to the rest of the world. Very advanced regulatory frameworks in Singapore. Obviously, US, it's moving a lot compared to, not to mention Europe, for example, where it's a struggle just to get in line with MiCA and everything. You know, when I was working in a bank in Paris, you had so much to even understand all regulations, like MiCA. It's not even speaking about digital assets. It's not even the correct term. It's about, you know, electronic money. So why this is, you know, helping businesses to build? It's not. So, I mean, we're both kind of from Switzerland, Zurich, Geneva, and you were saying very correctly is that Switzerland is kind of losing its first edge movement because people are coming now to UAE because they see the regulation is helping businesses actually, and this is how you attract, you know, business, money, and investors.
To further add on that, in the early days, we have seen companies moving into jurisdiction where there was no regulation. So they started as tech company unregulated. In certain jurisdictions, then licensing, either prohibitions or licensing requirements kicked in. So they moved to the next jurisdiction where there were no licensing requirements. But then this jurisdiction also started to implement regulatory frameworks. And nowadays, it's quite hard to find a jurisdiction where you need no license at all, where you're, as example, a centralized exchange, right? So that means the jurisdiction battle not any longer in terms of regulatory arbitrage and who has no license requirement, but rather who has a robust but still risk-based requirement which actually effectively mitigate the risks which obviously cryptocurrencies inherently have in terms of money laundering risks, sanction evasions risks and the likes, which is more a market integrity part, but at the same time also what are rights of consumers. So what type of risk disclosures are required, how do you need to educate users from a more compliance angle. And here, obviously, if you have too heavy compliance burden, then it's less interesting from a business point of view. But if the compliance burden at the same time is then too low, then obviously you don't have the quality which actually you would like to expect, that regulated entities in your jurisdiction have robust frameworks, therefore attracting more institutional players, and also these type of investors who actually want to sleep well at night in case of or your assets protected in case of a bankruptcy of a crypto exchange. And what happens if exchange has incident like being hacked and so on. So there is a competitive advantage in being domiciled in a jurisdiction with appropriate regulatory framework, which is not too much of a burden, but at the same time provides a certain level of quality.
Yeah. So, I mean, one of my big learnings, ETH Denver in 2024, USA were like, we're all going to Dubai, we're going to Hong Kong. ETH Denver 2025, everyone was like, USA, USA. And the change that we've seen in a year in the US since Gensler has left, and the change is just amazing, the speed of everyone going back onshore in the US. For these global institutions, with all the change, and obviously the US is suddenly whipped forward this year, but how realistic is it for them to remain compliant in all of these jurisdictions and all the conflicting rules? You mentioned it with Mika earlier, like here you have to do this, in the UK you've got to do that, in the US you've got to do UAE. Is that realistic, or does there need to be a consensus?
Doesn't need to be a consensus. I think everyone has his own legislation, everyone is moving its pace. Speaking about exchanges, I mean, when you launch a token, you have to comply with different jurisdictions. A white paper here won't be good enough for Europe, so you'll have to complain and see different, regulatory frameworks. Back to US, we can just thank what's happening since few years, right? Yeah. Even if we take aside politics, if we just focus on digital assets, because it's helping the industry to develop, it's helping to develop standards, and it's also helping probably governments to take some decisions that were not even in their scope. So I think it's a good trend. Now, I'm not a specialist of US regulations, and I think there are more to come. There were promises. We see the first, let's say, steps. But yeah, I think it's in a good way, but takes time.
Yeah, it's nice to have a genius and a clarity
exactly.
act. But I think sometimes when we've been talking to government over the last 10 years, they're like, we don't want to talk to this industry. It's much easier for them to be like, right, US congressmen are writing this, let's copy it, first trying to talk to the Web3 industry. Did you have a point? If not, so how should digital assets firms balance innovation and compliance without killing that agility? How are they making these really good products for the consumers, but also being compliant?
The challenge of being in a regulated industry is that you cannot just go and break things, right? So that is possible in a lot of industries where you just can try, test, get user feedback, pivot, and redo till you find your product market fit, right? In regulated industry, you cannot have the same level of risk appetite, because if you breach regulations, that has severe consequences, either on the level of an institution or then on the level of the individuals who might be then not any longer fit and proper, right? So, and that obviously is a challenge from agility point of view, from innovation point of view. And when we say regulations in digital assets or regulations of cryptos, we have basically two types of players in the market. So we have one's the TradFi players who do traditional financial services for decades. They fully understand what it means to be regulated. They fully understand what it means to have compliance framework in place. And most of, at least the globally operating financial institutions have been fined in the past due to various violations of AML requirements, sanctions requirements, and therefore they have very little risk appetite to test out new things without clear regulatory guidance and without clear approval of the regulators. And then on the other side, we have more the crypto native firms who either started as unregulated players and are now adopting, or those who go directly for a license before start with their business activities. And here there is obviously a difference of the risk appetite and also the expectations towards the legislation, the expectations towards the regulators. And here it's obviously safe to say if your risk appetite to be innovative is smaller because you made your experience in the past with enforcement actions, with fines, then obviously you don't test out that fast. But at the end of the day, we also have seen like sandbox regimes where actually you can try out new technology in a very compliant way, not necessarily commercial by day one, but still allows regulatory institutions to try and test out. And I think this is absolutely the right approach, where you can test new products, test new services in a protected way, make your learnings, reiterate, implement additional controls if the result was that control environment needs to be strengthened, and then launch it into the market. And here obviously it helps if you have regulators which are enabling that approach for the benefit of markets in general, but also then for the consumers and investors.
Not running your business on QuickBooks.
If I speak about ADI Foundation, you cannot scale if you're not compliant. We are providing the rails for institutions, governments to build on chain. If we don't comply, we just cannot scale. It's as it is. Yeah. It is. If you are speaking about cross-border payments, if you are speaking about stable coins, it means it's fully regulated. So I can just approve what was said just now. Yeah.
So I know in TradFi there's lots of like rating systems, like Bank of New York is a AAA rating. They've been following crypto for a long time. They may finally be going in, but like they didn't want to lose their AAA rating. If I'm an investor, like what are the warning signs the company treats compliance and afterthought, and how can I work that out when I'm looking to invest in a DAT? Or, what are the signs to look for? Are there signs?
So I'll speak about a blockchain point of view, right?
Yeah. Or DeFi.
Or DeFi. If there is no mention of anything, it's a red flag. If it's vague, if it's fluffy, just don't go for it. It's really not a good sign, especially today. You have audits. You have like open source anything, right? You have to show your investors, you have to show anyone that what you are doing is compliant, is regulated, is safe, actually, right? How many scams, rug pull are in the market? I don't want to say 90%, but at the end of the day, what exists today, what will exist in 5 years' time, I'm sure half of it will be gone just because of lack of openness, so that's very important. That's why you see, if you back like 10 years ago, if you would go on CoinMarketCap, you would see the top 10.
Yeah. Everything's
go back today again.
Everything's just a Bitcoin fork back then. Yeah.
Exactly. You see Bitcoin, Ethereum, maybe one or two guys like Cardano-ish, and then they have all disappeared, and there must be a reason for that. So, that's the trend of being a red flag to me.
And exactly, doing all this due diligence as an investor is quite time consuming, and you also need to have quite some know-how to understand these risks. And this is also then an entry barrier to basically mass markets, right? And this is exactly where regulated TradFi player can play an intermediary role in doing this due diligence and basically curate a list of innovative DEXs or other DeFi solutions which they vet, and then give their client base access to it. So their clients don't need to do the heavy lifting in reading audit reports or reading code by themselves, which obviously most people anyway cannot do it, because at the end of the day, financial services are shifting on-chain. We've seen that in DeFi with vaults as example, right? Asset management can be done fully on-chain. I don't need TradFi player anymore, but the mass market are still the less educated users or the institutional capital. And if these players can basically become a bridge in filtering, curating, identifying the top quality projects And that will help then to unlock additional capital, which would be not willing or ready to invest in this type of platforms or get access to yield which is generated on-chain.
Yeah, nice. And so when we're looking at culture, how do we create a compliance culture that's proactive rather than reactive? You know, one that prevents crises rather than just responds to them.
I think if it's reactive, it means something went wrong from the very beginning. It means you didn't, put the rules in place from the start. It means you are trying to catch up. I was mentioning earlier on Polymarket. There might be thousands of other examples. So you have to be proactive, but that comes with, building along with regulators that gives you guidelines that actually help you shape the product you are aiming to have. That's the key. Being reactive is kind of a silo thing, which is a wrong sign. So you have kind of, I don't like this term, but kind of be agile about it and build along.
I mean, obviously for policy makers and legislators, after a crisis, there is obviously a strong call to action, right? Yeah. And then the tendency is to over-regulate. But at the same time, it's also responsibilities of the regulated institutions and the market players, also in terms of self-regulation, that actually they allocate enough resources to mitigate risks, educate consumers about risks, and have robust controls in place to also prevent the next big thing happening and not just waiting for new regulations, because then obviously regulators then or legislators are imposing then quite some strict rules as a strong reaction to failures in the market, right? And here nobody is closer to the market than the market participants, i.e. the exchanges as example. They understand the risks, but there must be also a willingness to actually mitigate these risks and not just waiting for the next wave of regulations.
Well, like many of us, I wait for Michael Saylor's red dot on a Sunday or a Monday, as he added 900 million this week. The guy is just buying it all. But what role does transparency play? Is he just tweeting that he bought 900 million? Is on-chain analytics or proof of reserve needed to restore market trust and that people are actually holding these reserves?
Definitely, you need on-chain analytics. Proof of reserve, I mean, we all saw how much it's needed. The FTX thing was a good a good red flag. It was 2022, I think. Yeah. Yeah. So that's the best example ever. One exchange crashes, you discover what's happening behind the scene, and then suddenly, I think Binance was the first actually to say, "Hey, this is a proof of reserve. This is what we have. This is where we don't play with our users' funds and everything." So yes, it's needed. On-chain analytics also. I would prefer decentralized analytics, not to have a single point of failure. Just to be sure, it's a proof of on-chain analytics, kind of. So it's a mix of both, which is very much needed.
I mean, such public sources or enhanced transparency is balancing out the increased risks which you have inherently in crypto due to various reasons, right? So on one side, it's very easy to move assets worth billions outside regulated rails cross-border without any regulated financial intermediary, which is resulting in a higher risk. But at the same time, you can also mitigate inherent risks by this greater transparency, both from investigation point of view, following the money trail, but also from a transparency point of view where you have additional data points which you don't have in the TradFi world. So therefore, at the end of the day, these are instruments which consumers and also the public can use to exercise an additional layer of control, which then also gives more trust in the market, which is a prerequisite to further scale the industry.
Awesome. Well, thank you everyone for listening to our compliance panel. Compliance people are actually the rock stars in crypto. I remember when there used to only be 5 in London. They were all on a WhatsApp group. They kept on getting more and more and more because no one actually wanted the risk of being a compliance officer. So finally, to wrap up, my last question, Will the next wave of institutional capital flow to the most innovative projects or the most compliant ones?
Both.
Both, okay.
Well, I think a diligent investor looks into various parameters before deciding about an investment, and nowadays the question of compliance is for sure an important one to address.
Awesome. Well, thank you very much. A round of applause to our brilliant panelists.
Thank you.